Welcome back to Profit Path, where we keep it simple so you can make investing easy. Today, markets are reacting to surging bond yields and a pullback in tech. Gold continues to shine while investors await Friday's crucial jobs data. Hit subscribe for clear, daily stock market insights. In our lead story today, long-term bond yields rose sharply across the US, the UK, and Japan yesterday as investors grew more cautious about rising government debt and darkening economic clouds. The moves came as global oil prices rebounded above $90 a barrel, adding to inflationary pressures just as central banks look set to keep monetary policy tight. Japan's 30-year bond yield hit an all-time high of 3.28%, while the equivalent US Treasury yield touched its highest since April at 4.81%. The 10-year UK gilt yield also climbed to a 4-month high of 4.57%. Now, higher bond yields typically result from increased inflation expectations, which can erode the value of fixed income assets and might prompt central banks to hold interest rates higher for longer. It appears that's what's happening here. Investors seem to be rethinking the likelihood of aggressive rate cuts by central banks given recent economic readings and the resulting effect on bond prices. With the Federal Reserve, Bank of England and Bank of Japan all set to review monetary policy in the coming weeks, markets are keenly watching for any signals regarding the future trajectory of interest rates. Rising yields can also signal economic uncertainty and risk aversion among investors, as they seek safety in government bonds, pushing yields even higher. It's a bit of a vicious cycle. Meanwhile, gold climbed further to a record high of $3,546.99 per ounce yesterday, building on the previous day's record close. The precious metal has been on a steady uptick this year, bolstered by central bank buying and concerns over escalating geopolitical conflicts. In contrast, silver fell slightly to $46.55 an ounce. Turning to stocks, US stocks earlier posted their weakest day in a month as manufacturing continued its sixth straight monthly contraction, pointing to persistent weakness in the sector. The S&P 500 fell 1.3%, with all but one of its 11 sectors declining. The index is now only 4.7% above its June low, making it technically in a bear market. Weakness in big tech, especially Nvidia, Amazon and Apple, led the slide, with each of them falling between 1.5% and 3%. Nvidia was the biggest decliner in the index, dragged down by a Morgan Stanley downgrade and weaker than expected quarterly results from another chipmaker, Micron, on Tuesday. The Pan-European stocks 600 closed down 0.4%, while the DAX in Germany outperformed its European peers, rising 0.2%. As data showed, German exports unexpectedly increased in July, suggesting resilience in Europe's largest economy. In our next story, hedge funds have retreated to the sidelines this month, becoming net sellers of stocks in August, for the first time since May, as a combination of elevated valuations, fragile market conditions and looming seasonal volatility pushed many funds to pull back exposure and reduce leverage, according to data from Goldman Sachs. In fact, the data shows that hedge funds have become less optimistic about the market since mid-July, when the S&P 500 was trading around 4,700 versus around 4,400 now. However, not all sectors are equal in the eyes of Wall Street pros, with some seeing select areas such as defense and renewable energy as having recently drawn interest following their pullbacks from earlier highs. For instance, analysts at Bank of America, citing their fund manager survey, noted that investors see the most attractive sector as being energy and materials, both of which are up around 10% year to date. But perhaps the biggest takeaway from the latest data is that hedge funds aren't positioning for a large move either way, signaling a potential period of consolidation in the market. In our final story, strategists at Morgan Stanley, led by Mike Wilson, suggested yesterday that markets haven't yet fully priced in the good news, the full benefit of the expected rate cuts in the second half of 2024. They argue that the pricing for a 100 basis point cut by the Fed this year is too low, and advise viewing September as a good opportunity to buy the dip, particularly for small-cap stocks which tend to be more sensitive to interest rate changes. While acknowledging that the current environment is challenging, Wilson and his team see the sell-off from recent highs as creating opportunities for investors with a long-term perspective. So that wraps up today's. To recap, bond yields are rising, tech is under pressure, gold is near record highs, and hedge funds are cautious, but some sectors are drawing interest amid rate cut optimism. So the question for you, do these latest developments have you thinking the market is bracing for a rally or a pullback? Let me know in the comments below. And don't forget to hit subscribe for a daily dose of actionable insights from the world of stocks and finance. Have a great rest of your day, and I'll see you back here tomorrow.